All right, so this is number 1, and this is for the chapter 1 homework on income tax accounting. It says Treasury Department Circular 230 provides guidance for doing which of the following activities? And the answer is number A, or letter A, I guess. Practicing before the IRS. Okay, that's number 1. Okay, so here's the second question. I'm redoing it. Which of the following, well, let me scroll it down a little bit just in case the worst happens with the stupid iMovie. It wants a specific aspect ratio. Which of the following is not required conduct for a preparer of an income tax return under AICPA tax standards? And to verify the information the client provides is correct. It's assumed that it's correct because you're the one supplying the information. Okay, so here's number 3. It says choose from the drop-down list the probable justification for each of the following. Okay, so a tax credit is allowed for amounts spent to furnish care for minor children while the parent works. Well, if it's to support working families, then that's going to be a economic and social consideration. And that's what it is. Deductions for interest on home mortgages and property taxes on a personal residence. So the concept behind this is they want to encourage people to own houses. So that means it's going to be an economic and social consideration. Okay, fines and penalties are not deductible. So allowing deductions for fines and penalties would basically be rewarding bad behavior. So this is a social consideration. Okay. Net operating losses of a current year that can be carried forward to profitable years. So this is going to be considered an equity consideration. And the concept behind it is a business that loses money one year but profits another year should be treated fairly over time. So that's kind of like the idea behind it. A taxpayer who sells property on an installment basis can recognize gain on the sale over the period the payments are received. So that's a wherewithal to pay concept. And the rule is basically to ensure taxpayers pay only when they actually have cash in hand. Okay? So F. The exclusion from federal tax of certain interest income from state and political bonds. That is a political consideration. And your hint here is the municipal. So it lowers the borrowing cost in local and state government so that they can function better. That's the idea behind it. So G, prepaid income is taxed to the recipient in the year received and not in the year earned. That's a wherewithal to pay as well. Even if not yet earned, cash received increases your ability to pay. So that's the idea behind that. That's number 3 on chapter 1. Okay, so here's number 4 on the chapter 1 homework. It says, Mia owns a warehouse that has a cost basis of $80,000. The city condemns the warehouse to make room for a new fire station. It pays Mia $400,000 for the new property. It's agreed to fair market value. Shortly after the condemnation, Mia purchases another warehouse as a replacement. What is her recognized gain if the new property is $280,000? So, let's see. The government gives you $400,000. That's your new property. And that's what the government gives you for the land. And you purchase $280,000. That would equal 120,000. That is your recognized gain. That's for letter A. What is her recognized gain if the property cost is now 444,000? Okay. So we just do the same thing we just did. Well, it's going to equal negative 44,000. But we're just going to say 0. It's technically negative 4 in the negatives, but we're going to say it's 0 because it's that's the there is no gain, basically. That's what I'm trying to say. What is the recognized gain if the new property cost is 80,000? Okay, same thing. Yep, that's A, B, C, and what, if any, is the justification for deferring the recognition of gain on the involuntary conversion? The wherewithal to pay concept. And the taxpayer's position has not changed. So, hopefully my mic is on. I'll have it checked. All right, here's number 5, and it says, how does the pay-as-you-go procedure apply to wage earners? And let's see. The answer is, the tax law requires employers to withhold a specified dollar amount from wages paid to the employee to cover income taxes. That's the answer verbatim. So, all right. How does the pay-as-you-go procedure apply to persons who have income from other sources besides wages? And the answer is, the tax law requires the taxpayer to make quarterly payments to the IRS for estimated taxes. That is number 5, I think. I think it's 5. It's either 5 or 6. Okay, here's 6, and it says, the Adams Independent School District wants to sell a parcel of unimproved land that it does not need. Its 3 best offers are as follows, and it gives us these 3 options. If you are the financial advisor for the school district, which offer would probably be preferable for a long-term financial standpoint? When we talk about ad valorem taxes, that has to do with property taxes. So, essentially, we're going to go with Baker Motors. And the reason why is the property tax is better than the other options. Even though the offer is slightly less here, the property tax is better than the other ones. It's easiest to explain. It explains it right here. I'll just read this for us. Property taxes on realty are used exclusively by states and their local political subdivisions such as cities, counties, and school districts. They represent a major source of revenue for local governments. And they get the most out of Baker Motors, basically. And that's number 6. Okay, so I need to re-record this video, apparently, because apparently it doesn't want to play nice. But, okay, so I'm going to leave this on the screen for a second. Okay, you can read it. So, Jake, a multimillionaire, blah, 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 blah. The annual transfer to exclusion to, the annual transfers will Jake to use the annual gift tax to avoid tax on at least part of the transfers. The annual exclusion is indexed for inflation, so transfers in subsequent years may benefit from a larger annual exclusion. Okay. Using the annual exclusion will reduce the total amount of taxes on the transfers Jake will make to his friends. Okay. The tax on any transfers in excess of the annual exclusion will be offset by the Unified Transfer Tax Credit. All right. Which, if used each year, will reduce the credit available when he dies. And the last one is increasing the estate tax. And that is that one. All right, so here's this question. Should be able to read it. I know the other question got messed up because of the aspect ratio. All right, so differentiate piggyback approach from decoupling. For state income tax purposes, piggybacking means using federal tax income as a state tax base. Okay. By decoupling, a state decides not to allow a particular federal provision for state income tax purposes. So the state is decoupling with the federal provision. And that's decoupling. Okay. So states often use the IRS results to identify errors that might also exist at the state tax return. Most states allow their residents some form of tax credit for income tax paid in other states. All right, I think this is the one I'm missing, and to do it quickly, this one's going to be more. This one's going to be larger. This one's going to be granting a credit or rebate. And this one's going to be low income. I got to do this one quickly, so oops, didn't mean to do that. Okay, so here's this one. All right, so the 3-year, okay, so you file them on February 19th. The 3-year statute of limitations will begin on April 15th on tax day because you filed your taxes early this year. You filed them after April 15th. The statute of limitations will be June 25th because you filed them late after tax day. The statute of limitations, if you never filed, well, there is no statute of limitations. So once the return is filed, that will be when it begins. And the same for this one, once the return is filed. All right, so we're speed running this, and Cooney is not right. There is no statute of limitations if you don't file your tax return. Only if. All right, so you can only recommend that they do the tax return, that they file their tax return. You should not undertake if you cannot correctly identify the tax liability for 2021. What ethical guidelines should you consider in determining whether to accept Cooney as a new client? As a CPA, you should consider the AICPA, Code of Professional Conduct, and SSTS, and Circular 230. Okay, that's that one. Okay, this is the last question. I'm just re-recording it because it got messed up. Jane, a tax practitioner, has reviewed the law on how a certain... Okay, I'll just let you read it because we're running out of time. It's the certainty and simplicity principles. Okay, that's that one.